Hi, my name is Michael Joyce from JoycePayne Partners, and I'm pleased to share with you today our insights and viewpoints for fall of 2017. A question that I often get from people these days is, how long can the stock market stay at these lofty heights? And that's a pretty reasonable question. The stock market has been really good for a long time. It's been a long time since we've had a correction in the markets. So to explain one of the reasons why the market has stayed this high for so long, I'm going to take you all back to your college economics course. The one that we took when we were freshmen. It was kind of dry and boring, but I'm going to make it exciting. So if you remember economics, they talked a lot when you first came in about supply and demand. So remember those supply and demand curves that intersected? And if one or the other shifted, it meant that there was going to be a change in price or a change in quantity supplied. Well, think about that. So when there's an increase in demand, so let's say that there's an increase in demand for iPhones, and Apple is still going to produce the same amount of iPhones. Well, the demand curve is going to shift up and the price is going to go up. Hence, you have the $1,000 iPhone. Think about the hurricanes that we just experienced and how that might have impacted the gasoline refineries in Texas and on the Gulf Coast. They couldn't produce as much gasoline, but we were all still driving the same amount. So what happened when gasoline supply fell is the price of gasoline rose, at least temporarily. So I'm going to apply some of these concepts to the stock market. A little known fact is that over the last 20 years, the supply of stocks, the amount of stocks that trade on the exchanges, has dropped nearly in half. So what you've had is more investor dollars chasing fewer investment opportunities in the stock market. The supply has dropped, so applying the rules of economics, prices would have gone up. So that's one of the reasons why stocks can stay persistently high. But of course, valuation still matters. So if valuations rise too much, if prices rise too much, then what's going to happen is as the prices rise, investors will look for substitutes and demand will then fall and prices will fall. So right now, we would look at investment income as a primary driver for many investors. So the 10-year Treasury note is now trading at about a 2.4% yield, which is slightly higher than the dividend yield on the S&P 500. But it's not hard to find stocks with dividend yields that are 3% or 4%. I mean, heck, even Verizon, which is a real bellwether stock, has a dividend yield that's over 5%. So at least for the time being, until interest rates rise, the bonds are not really going to be a good substitute for those looking for investment income relative to stock dividends. Now, interest rates also matter in terms of valuations. And we've talked about this before, but the value of any company, whether it's public or private, is the value of all of its future cash flows discounted back to the present value. Now, we don't know what all the future cash flows are going to look like. That's why stock prices move around every day. Investor perceptions of the future cash flows are constantly changing. But we do know the discount rate because that's going to be tied to interest rates. So when we're in a low interest rate environment like we are now, there's going to be a low discount rate which will yield higher valuations. So we can justify higher price earnings ratios right now. But if interest rates rise unexpectedly, then we would have a situation where the discount rate would rise and valuations would then fall. We also know that stock prices don't exist in a vacuum. There's all sorts of global events that could impact stock prices, both over the short term and the long term. It could be geopolitical events with North Korea or other parts of the world. It could be political events. It could be related to tax policy. Will there be a tax bill that will be passed? What will be in it? What won't be in it? So all of these things could impact stock prices. And we haven't had a correction in the stock market since January and February of 2016. And I've been talking for 6 months that we're going to have a correction at some point. But I don't know when it's going to be, and I don't know what's going to cause it. But if we would have a correction in the near term, we would likely just ride it through it. We do not view that a correction right now would be a precursor of a recession or the beginning of a bear market. So it would be perhaps even an opportunity for us to pick up some investments at more reasonable valuations. So talking about investment returns so far in 2017, it's been quite a good year. And what's driven a lot of these returns has been international investments. International equity indices are up 20 and 30%. So it's been a very good year. But that hasn't always been the case. And we only have to go back to 2015 to see that international equities had not very good returns at that time and were a drag on returns. But we're big believers in diversification. So we think that every investor should have at least some money in international equities. And at least so far this year, that's really paid off well. Now, bond returns this year have been in the low single digits. And I would argue that that's kind of a return to normalcy. Remember, bonds are our safe and secure money. This is our sleep at night money. So to get low single digit returns, that means that that is what we should be expecting from bonds over the long term. Now, as we go into the last quarter of the year, we think it's a good time to look at some financial housekeeping. And there's a lot of things that we can talk about, but I'm just going to touch on a couple right now. So first of all, we think that you should look at how much you've had withheld for taxes, or if you make quarterly estimated tax payments, how much you've paid in on your quarterly estimated payments. And what you want to look for is to make sure that you haven't paid in too much or too little. If you paid in too much, that means you're going to get a big tax refund next year, which may sound good, but in essence, you've really just given the government an interest-free loan with your money. And if you've withheld too little, that means you're going to have to pay a lot on April 15th and maybe be in a penalty situation. So that is something that you want to avoid, and it's not too late to make those adjustments at this point in time. We're also about to enter into employee benefits open enrollment periods. So this is the time where you're going to be looking at health insurance and other employee benefits. And I can pretty much guarantee you that health insurance coverages provided by insurance has changed year over year. So you want to make sure that what you're getting in health insurance, what you're electing in other employee benefits are what's optimal for your family. And the last thing I want to talk about in the financial housekeeping category is charitable contributions. For those that are charitably inclined, what I would suggest is instead of just writing a check out to charity, you may want to consider gifting appreciated securities to the charity instead. So you get a charitable deduction on your income taxes for the market value of the contribution, and you would be avoiding the capital gains tax on these appreciated securities. For those people that are over age 70 and a half, they can actually put a limited amount of their required minimum distributions and apply that directly to charitable contributions. And in that way, those people can make charitable contributions, in essence, on a pre-tax basis. I also want to let you know that here at JoycePayne Partners, we're undergoing a new branding initiative that we're all very excited about. Next quarter, when we talk, we'll probably have some more information about this, and I can assure you it's going to be exciting for all of us. And next year, coincidentally, is also the 25th anniversary of JoycePayne Partners, so we can tie all that in together. So I've been really happy to share our thoughts and viewpoints here at JoycePayne Partners for the fall of 2017. If you do have any questions, please contact your financial strategist or contact me. You can also find out about our thinking on our website, JoycePaynePartners.com, or follow us on Twitter at JoycePayne PTRS. Thanks, and have a great day.